The value of the dollar, it's bad. It's bad. It's no good versus gold.
Welcome to Metals and Miners. I'm its founder and its host, Gary Bohm. The US dollar has been the dominant currency since Bretton Woods in the 1940s. Today, it looks like the US and the BRICS are headed for a monetary divorce and that we're witnessing the birth of a new monetary world order. At the same time, it seems if we're watching a movie that we've already seen over and over again. US fiscal deficits are blowing out. Countries are accumulating record amounts of gold, and new economic and trade alliances are forming before our very eyes. To discuss all of this and more, we're fortunate to sit down with Geoffrey Fouvry. Geoffrey has been in the capital markets since 2000. He had been a risk arbiter with York Asset Management, where he ended his tenure as head of research with an impressive 14-year streak without a loss. He's founded several companies, including DocuTalk and Graph Financials, and he grew up in France, studied and worked in the U.S., and now spends most of his time in Brazil. Geoffrey, thank you so much for joining us today.
Yeah, you're much welcome. Thank you for having me.
Yeah. So, Geoffrey, how do you see the current economy and markets? Do you see it in a soft landing and new growth cycle headed for a sharp deflationary impulse or a stagflationary environment? What do you see?
All right. So this is relatively easy because when I was starting at York Asset Management, the trader next to me was trading Brady bonds and C bonds, Russian bonds, and basically the problem of fiscal dominance. In a fiscal dominance situation, you have a lot of government spending, and that actually typically does not result in debt deflation, because you have two sides in the currency. You have the pure credit currency. That's your 19th century banks in the US, where the government debt is not at all layered inside the currency. You have only gold and private credit on the asset side. On the other side, you have redeemable currency. So different banks issue different notes, and each note is convertible for gold. But you don't have a single central bank issuing banknotes that are not convertible, and you didn't have a central bank until until 1930. So in that situation, it's purely a credit currency, private credit currency, and when you have a plunge, debt deflation is very easy to define. It's when you have unreserved banking. In other words, you have very little reserves and you have a lot of credit. And as a result, credit, if I can go very quickly, there's money, bank currency in 19th century, and you have credit. Money is the token that cannot fail. It's your gold coin. Today, it's your ECB banknotes, and this is going to, or dollar notes. I'm using ECB because it's going to be very clear soon. And that's the token. It cannot fail. It's not a promise to repay in something else. It's not a promise in something else. Now, if you have a bank deposit, and at the time in the 19th century, both bank deposit and currencies notes were redeemable, but today, a bank deposit is redeemable in M0 banknotes, the token. In the past, it was redeemable in gold coins. So what happens is that if you have a credit crunch, you have too much credit because we know already what are the tokens. Okay, we know what is money, the base money. Now, the bank can create currency in two ways. It can create currency when you bring your gold coins in 19th century and give you a piece of currency, or you have a 90 days receivable that you want to discount. You go to the bank, you say, I have a good receivable, please give me some banknotes, and give you some banknotes. All right? But the banknotes are actually the ticket They are tickets that are a claim on money. It's like when you go to the, you go to the nightclub, you give your vest, they give you a ticket. That's the same thing. You give your coin, they give you a ticket. But when you have a lot of tickets, okay, and there's very little gold, and some of the credit is not going to convert into gold because it's bad credit, it's not in 90 days going to be converted back to gold, it's bad credit, then you have unreserved banking. You have too much tickets in relation to your base of money, your gold coins, your reserves. That's what happened in 1825, 1873, 1929, 2008. Today, we do not have a reserve problem because we have increased the amount of new gold coin, the reserve, the M0 dollars. We have increased that by 10 times. So to have a debt deflation 2008 style, you need bad credit and no reserve. Okay? Because when you have no reserve, the banks, they have two sources of liquidity. Either they can lend on their own reserves, okay, and they don't need to go into the repo market to find liquidity, or they have no reserves, and then they go into the repo market to find liquidity. And in 2008, I don't know if you remember, LIBOR went up a lot because they were unreserved, they were leveraged 30 times, okay? Goldman Sachs, etc. They were very leveraged, and they were going to repo, interbanking as a source of liquidity, and then you have junk in that. And then when you have that, it's unreserved banking plus junk in repo market, you have a freeze. And then the interbanking rate go up because nobody wants to lend to each other. And then if you don't print money at that point, because velocity goes, if you don't print money, you get 1929. So to answer, I added this long introduction, it's going to be interesting for other questions. No, you don't have a risk of 2008 because we have plenty of reserves. We have a problem of stagflation because, remember, we are 6-7%. Any spending from the government that is not mopped up by taxes is actually new liquidity. So I don't know if you, I think I answered the question of where we are, what are the typical situations. No, we don't have an unreserved banking. Yes, we have some bad credit, but we're not in a situation where there are no coins, tons of that. We have increased the amount of coins, the base money, by 10 times. So this is not
I appreciate
the main scenario.
Yeah, I appreciate you laying it out that way. I really do. And it's an interesting perspective that I hadn't heard quite put that way. And but you're not the first to tell me on this show that they're expecting to see a stagflationary environment moving forward. So thank you for putting it that way. So Zoltan Pozsar, a former senior advisor to the U.S. Department of the Treasury, he recently stated that we're headed for a monetary divorce between the G7 and the BRICS, and that we're witnessing the birth of a new monetary world order. Do you agree with him? You're shaking your head. Do you agree with him? And what do you see?
I do agree with him. And this is not something new because a lot of people do not understand where we come from, what is this regime. We are using foreign exchange as reserve today. We are using USD as reserve in other central banks. This is not the first time. It didn't start with Bretton Woods. It started with Resolution 9 of the Genoa Convention of 1922. And at the time, they allowed two FX to be used as reserve. The pound, British pound, and US dollar. And this system, and then they kept at the same time a convertibility to gold, which was way in extremis and way too low. So let's come back a bit of understand what are the systems and where we are in currency system. In the past, in the gold standard that started in 1873, gold standard did not start in the 19th century. Before that, you had almost four regimes. you had a silver bloc. There were Germany, there were the northern country, there were Russia, there were the Asian countries that were also on the silver. There was Mexico for obvious reasons. And then there was a gold bloc. There was the UK, I think there was Portugal, there were various countries in the 19th century which were on the gold bloc. And then there were two countries which were on bimetallic. There was the US and France. And then there, at some point, the US was on fiat with the Civil War. So you had actually 4 different regimes at the same time in the 1860s. And the fiat experiment is not only the US during the Civil War. Actually, the UK went fiat also because of war between 1797 and 1821. But the idea is this. In those regimes which were gold standard, that is not, people think that we had in 1929 a gold standard. No, it was not a gold standard. A gold, or even prior to gold standard, a system where FX is not accepted as reserves. So in the past, you could not, before 1922, that was pound and USD, you could not pay your trade deficit with currency. And it's a key difference, and we are coming back to that. Why is it a key difference? Because it's the FX as currency, FX as reserve, has the problem that it desynchronizes credit, trade, consumption, and production. So, before 1922, in the gold standard or other system, if you had a trade deficit, you would have a flow of gold, a slow flow of gold at the same time. And this flow of gold would reduce the reserves and the support to your credit basis. And it will also reduce the M0 in a way that would make the rates go higher. So it would automatically curb your overconsumption, curb the increase in prices, to force you to stop consuming too much, restore your prices a bit down, and then you restore your terms of trade. And as a result, at some point, the flow of trade inverses and you balance again. Okay?
And that's where we're headed. We're headed back to that.
Yeah, we're headed back to that. And it doesn't need to have a fixed parity to gold. So you can have that even if the currency, national currency, is in fiat. That was the case for the Bank of England in 1802. In 1802, it was in fiat because of the war. When they had exports to Hamburg, and Henry Thornton, the great book, which is the credit, paper credit of Great Britain, explains that. He explains that when they had a trade deficit with Hamburg, they were paying with bill of exchange, and what would happen is that in Hamburg, someone would have those bill of exchanges in Bank of England notes. If there was someone willing to import back from the UK to Hamburg, okay, there would be no problem. But if there was too much imports and not the amount of export in Hamburg, what would happen is that people would discharge those notes against gold, and then the notes, again, Bank of England equivalent, bill of exchange denominated in Bank of England, they would go down against gold. So you would see a premium of gold in Hamburg versus the price of gold in the UK. And they would create a spread. What do we see right now between the gold price in the US and China? We see that. For someone who's versed into those old systems, it means that the Chinese are discharging the FX. In other words, they say, you know what, we don't keep, because FX as reserve is just you get the FX, you don't dump it, you keep it. And against that, you create your own national currency. So in that situation, you pay with your FX, and there is no impact on the currency, okay? Because they're not dumping it, they're not discharging it. When you have a discharge, like I explained with Hamburg and London, or today US and China, what you will notice since the beginning of the year is that Chinese currency is not devaluing, even if it has a very low rate, because they are using the second way to impact currency, which is discharge of FX against gold. So how does it work? You have this spread. Now you understood that why there's the spread, because the guys say, I got your FX BOE notes in 1802 in Hamburg. Sorry guys, we sell it and we find out how much it goes down against gold locally. All right, there's a spread. And then what happens is that some people would take advantage of the spread. And the taking of advantage of the spread is what impacts the currency. Why? People borrow US dollars, so they short US dollars, they buy gold at a price lower. They sell gold in yuan in Shanghai against yuan. So net, if you cross the gold in the middle, is basically shorting US dollar, buying yuan. Same as 1802, explained by Henry Thornton. So I will provide later, if you want, some references and those specific extract where I explain this mechanism. We have this mechanism. Now, why are we coming back to this system? Because as you understood, when there's discharge, what happens is that you're not double counting purchasing power. You're transferring purchasing power when you're shipping gold. Either when we are in fixed currency, because you send the gold back, even if your gold standard and the currency are pegged, each currency is pegged in your gold standard, and you're leaking gold slowly, okay, then what happens is that your rates go up because your M0 is kind of doing a very slow QT, but it's synchronized with your trade, prices go down, but at some point, your price go down, it's great because your trade balance is restored. Now your internal prices go down, you're more competitive for trade, so it's balancing. When you're sending your currency, this doesn't happen. You double count, because when you send US dollars, they actually never leave the US. They are immediately redeposited in the US because it's not usable in China. So when you send US dollars in China for trade, you don't have this mechanism of forcing down your consumption, because the dollar has all immediately redeposited, and then they're also used to create local currency. So what happens is that you do not lose, you just duplicate the purchasing power, and you have these huge purchasing power parity gaps because of that. That's because of that the US has its productive capacity, its manufacturing hurt, because the currency never adjusted. It's always keeping high because people accept and don't dump to force balance between consumption. And you have not enough consumption in China because they actually did not transfer the purchasing power. They just got diluted with everybody else. So it's very, very, very inflationary, because every time there are imports, you actually create new reserves in the exporter country. So that's why we have, since 1922, we have a huge inflation. Before that, when it was transfer, not double counted, inflation was much lower. Does it make sense at all?
Yes, it does. So, but you're seeing this system changing.
Yeah, we are going back to a system where we go to bills of exchange. Bills of exchange was not using a third-party currency. It's basically, you have trade between, I don't know, France and the US in the 1860s. I'm choosing this date on purpose because the US was on fiat. And what happens is that, all right, so US wants to import some wines in the 1860s from France. They got some bills of exchange denominated in fiat US dollar, they're going to dump it against gold, and we'll find out what's the price. They're not going to keep the fiat US dollar of 1860s. You see, so your import has a direct impact on your FX, your currency versus gold, because someone is dumping. Okay, it's not, the gold market was taboo to be used as a way to discharge trade balances post 1871. So when they unlink, they say, okay, we unlink, but don't you dare using the gold market to dump our US dollar. It's just for the lulz, a little bit like Bitcoin. It's just, it's not really serious. It's not for real. It's not usable as a way to say, you know what? I don't care. I have some US dollar. I can buy something from you in your country. I'm going to buy your gold. Okay? And then you're going to get your dollar. I'm going to get your gold. So that's really what's happening. And then, so bills of exchange is a way where people don't trade every item with gold. They just settle. You have a bit of accumulation from time to time in currency. They just settle the difference, the net difference in gold. Otherwise, you have bill of exchange in both ways, okay? And if they perfectly balance, there's not even any payment in gold.
So this is going to be an increase. So gold as a settlement vehicle is now going to be needed more in terms of production in order to meet the needs of the settlement.
Yes, and basically the purchasing power parity gaps that happen because I pay you with, your trade deficit is in abstraction, the purchasing power parity gap is in abstraction of trade balance. That's only possible if people keep your currency and create local new currency against it.
Which is what they were doing.
With post 1922, with pounds and US dollar, they were doing that. Post Bretton Woods 1, they were doing that. But what they kept at the same time is a in extremis convertibility at a price which is not realistic. Instead of having a pedal brake, that's the true gold standard, is a pedal brake. You consume too much, you're leaking a bit of gold progressively. They mixed up the two. They said, okay, accept my FX and let's put a very low in extremis convertibility price. That's basically the FX enables you to double count back and forth, so it's increasing. And that's why you had the 1920s boom, because it double counts reserves and there's no break. You don't sacrifice anything. You can consume without losing the credit base of your country. You send the currency to consume, but it doesn't affect your interest rates or ability to consume. So you actually consume twice. Because you're sending FX that is then used as FX in the other, as reserve in another country to consume, but it hasn't left your own country. So that's why it's inflationary. Because you're not transferring, you double counted the purchasing power.
So as we go back to this, to a version of this older monetary system that you just described, I'm guessing the date would be pre-1922. What effects are we going to experience here? What is the average everyday family going to experience as an effect that they didn't experience prior?
All right. The first effect is that consumption is going to suffer in the US. That's the first thing. As we go more and more into that, there is another side, is that the huge ball and chain that is the FX as reserve for US producers goes away. So the exporter are like, yes, the US exporters, because all the time you have FX as reserve and it doesn't balance, you're like the UK in 1925, their currency is overvalued, they keep consuming, they have inflation, but you still have a currency which is too high for your exports. and your manufacturing gets hurt because of that. When we move to this, then as a result, the US manufacturing is not hurt anymore. You have
So
to
the
remember that
value of the dollar?
the value of the dollar, it's bad. It's bad. It's no good versus gold. Okay, versus currencies that use the dollar as reserve, that accept unconditionally to get the dollars and use them as reserves. It's a bit like gold between 1893, 1891, and 1913. What do I mean? Oh, why is it gold? Because you had discoveries of gold in you had the cyanide process in the 1880s, then you had the South African discoveries, and then you had the Klondike. So you have expansion of gold, and you have a bit of inflation because everyone is on gold, right? Until 1930. Not the inflation with fiat, but you expand the M0 of whoever is on gold, then okay, that impacts everybody. So whoever is on dollar standard, like G7, they accept unconditionally, they will go down along with the standard. That's why I took the example of gold. I don't know if it's clear. But then they have another thing, is that the US is using seigniorage on its own on the dollar, but those countries have a second level of seigniorage or financing debt. So countries which use the dollar, they have the seigniorage or the inflationary or excess of currency issuance against the dollar, plus in their own country they add another layer. Now, the countries that are cheating the reserve, they're saying, you know what, I discharge or I use swaps in trade, then they might actually be could outperform the dollar. But those who are using the dollar, well, they're stuck with the standard. They go down with it.
So it's more the hard asset of gold that's going to rise versus the dollar, and so therefore
I would
purchasing.
say, go ahead.
Therefore, purchasing power in fiat U.S. dollars is going to drop.
Yes, it's going to drop. But there is at some point, so people say, "Oh, it's going to collapse. It's going to collapse." Well, if your currency is not used as a reserve anymore, I tell you, the U.S. Productive capacity, the U.S. can build stuff. If they don't have this chain of FX that is always too high because of reserve, you remove that, it's actually stabilizing both the trade deficit and the budget deficit. If the U.S. government doesn't do a stupid thing, because you consume more than you produce because of what I explained before. Okay. Well, if the currency is competitive, you produce locally, and then you have more taxes, and the government doesn't have to plug the GDP with debt because taxes are getting in, people are employed. I'm not plugging the gap between consumption and production. So if the government doesn't do stupid spending, doesn't do stupid thing, you have a de-dollarization means less purchasing power, less huge gap of prices because everything is 2-3 times cheaper in other countries when U.S. people, citizens go abroad. They see that. This gap shrinks, but the manufacturing and the local production, in theory, should get better in the U.S.
Which would also create more jobs.
Yes.
Yeah.
But in the meantime, you're going to see, whoa, my currency against the gold is going down.
So there's a transition that is going to take place here that I don't know what the time frame would look like, but there'll be a transition of some pain and rocky road ahead, and then it'll level off, and then actually it'll be good for production back here at the States.
Yeah. Yes. If the government, U.S. government, also is reasonable and say, you know what, we have excesses. De-dollarization is not so bad if we take advantage of it, but we need to be reasonable with our budgeting and everything, if they could take advantage of that, then eventually it stabilizes. Because you have to remember, the highest level of growth, a lot of people get stunned with that, the highest level of growth in the US was between 1866, just at the end of the Civil War, until 1913. And this is going to smash a lot of preconception of Keynesians, because outputs expanded by 4 times, population went up by twice or more, a bit more than twice, and prices went down by half.
It's amazing. So do you see this as a necessary transition that has to take place? You know, the next question I wanted to ask you was about some generational conflicts that we're experiencing here in the States, and you may be experiencing over there in Europe as well. There's wealth gaps, and those wealth gaps are growing. The younger generation is struggling to buy homes and make ends meet, and that's despite even having good jobs. While the baby boomer generation, they're wealthy, they own all the assets, and they were able to acquire the assets cheaply, and now all of those assets have risen substantially as the Fed has printed trillions and has kept interest rates near zero. Do you see what you just described as part of an answer to repairing these internal conflicts, or how do you see these internal conflicts resolving?
All right, so those internal conflicts are entirely due to money printing. Okay. Now, there's a misconception about the wealth of a country. If you look at Henry Thornton, I cite him because it was praised by Keynesians, by Austrians, and by the Fed as the father of modern central banking. And he said the wealth of a country is the productive capacity of the country plus external assets, what people owe you from abroad as a country, what other country owe you, minus your external debt. And he says the paper price has no impact in that. So he says even if the paper price doubles, that doesn't mean you produce more things. So if you have a paper claim on a company that you have printed money and this has absorbed a lot of those money, and the price of the paper doubles, that doesn't mean that you are richer as a country, because the wealth is the productive capacity of your country plus what other countries owe you, less your external debt. And internal debt cancels out. You know, what your cash balance at the bank is the liability of the bank, or a company that owes debt to a neighbor in the same country. One is the asset, is the liability of the other. But that doesn't create its means of, okay, you have means of circulation. Means of circulation is not wealth. Wealth is the ability to produce goods and services that are in demand. Okay? That's the wealth. So by printing money, you can distort the prices of the asset, and you can have a wealth effect, and you can actually have the impression that you're getting richer while the country is getting poorer. Also, if you don't invest in R&D, and a lot of companies in the US do not do that, you have Boeing, okay, case. If you don't invest in R&D, but you owe more to other countries, you're not getting richer. You're not, even if the price of your stock is doubling or tripling.
So
you understand
I hear what you're saying, and I completely agree. But there's strife here in the States between this younger generation and the older generation, because one holds the assets and one can't acquire those assets because they're so expensive. they're inflated by what you just described. How do you see that strife? Do you see the asset prices coming down? What do you see
You have to
happening?
have you have to have either at some point someone who says, let's be responsible and let's balance our budget, put our house in order. There are going to be, if there is some the casualties on the market, because if casualties in capital markets, so be it. Okay, but the people in power, they don't want that, and that's the problem. So if they don't do that, they have a big risk of more political, let's call that decay. You know, it's Keynes citing Lenin saying the best way to destroy a capitalistic system is to debauch its currency. That's the best way to destroy society. At some point, someone will have to say, stop this charade. And, everyone is saying, oh, this is terrible, what's going on in China. This, I'd say, speculators getting wiped off, because there is a big lie that's going on. I'm not going to go, people say, a big lie. Okay, we're going to see here some conspiracy. No. Some people are going to pretend that you either have 1929 or we are forced to do what we are doing, which is printing. This is false. 1929 was a situation where the central bank did not do its job. A proper way to deal with bad debt is not 1929, but it's not what we do. What has happened after 2010. In other words, Bagehot, I don't know if I have the right pronunciation, probably not, Bagehot, the author of The Economist, or Thornton, was saying, look, this is what you do when you have bad debt. You're going to ring-fence the money market so the economy continues to function, right? But you do not monetize bad debt. You let the bad debt go into orderly liquidation without having contamination in the broader economy. What 1929 was they didn't maintain the money markets. They let everything go down. What you have to do, you ring-fence the money market so they continue, because we had in 2008, we had a GE could not get some, I think they had commercial paper. You can't let that happen. You have to, as the credit is contracting, you have to expand your notes during the panic, but not after. Just during the panic, you expand your notes in order to avoid price to plunge, avoid 1929. After the panic, okay, let's look at who has got some asset and who's done some bad stuff. I'm sorry, you guys, you have to go. You are going to go bankrupt. It's not going to contaminate. There's not going to be contagion. The economy is going to be tepid for a while, but it's not a plunge. That's the Swedish resolution of beginning 90s. That's Bagehot Thornton. And when everyone is saying, oh, they have to print, they should buy and stuff in China, I think they are in this situation where they say, you know what? You speculated into those big real estate, you go bankrupt. My only job is to make sure that the money markets there's no contagion. Now, in between, your stock market is going to be like, doing nothing. But the message is, you guys are speculators. You want me to bail you out and buy your stuff at par forever? I'm not going to do that. The Fed should have stopped in 2010.
So
after the panic and bad assets.
So the massive speculation, the excessive speculation that we've seen over the last 15 years, those more speculative, frothy asset purchases, wherever they were, whatever asset classes, you expect those to get wiped out, but on the whole, you don't expect contagion?
I see a fiscal dominance. Here's the sequence. You have two sequence and you have a four. You have, and that's typical of what some of the stuff that happened in Latin America. You have private credit crisis that is kicked up at the government level. Okay, so it's kicked up at the government level. The government takes that. Then the government keeps monetizing bad assets. So you get into a government debt bubble. And then this government debt bubble morphs into inflationary bubble. Why? Because government debt is not debt. It's money. What? Let me explain. As I explained, the credit is a promise to repay money. So when you have private credit, if you can't refinance, you have to find money. So you do a liquidation to try to get something and find money to repay your debt. That's 1929, 1873, 2008. That's for private credit. Because it's a promise to repay money, it creates a reflux, it creates a refinancing problem, it creates a crunch, right? Question, since when a government has a refinancing problem?
Not when they can print their own money.
Yeah. So even if the rates are higher, they are not going to be stopped by higher rates. In the private sector, higher rates, I can't pay my interest. Contraction. Look at Argentina. They keep borrowing at higher and higher rates. Government debt is not creating this crunch. So when you convert that private credit into government debt, you actually have too much money, a money bubble. And a money bubble is inflationary.
Interesting. All right, so I want to shift over to oil. Today, oil prices they're elevated. Carbon neutral ESG narratives have moved investment away from oil for more than a decade. What do you see for oil over the next 1 to 5 years?
Well, I think that we have underinvested in hydrocarbons. That's absolutely true. On one hand, I have personally traded back in June last year on that, saying this is crazy, the price is 60, that doesn't work because the cost of production in shale is higher. That was a successful trade. There is something I didn't see is how fast China is moving to EV. And why are they moving so fast to EV? I had a friend who just went there and said, it's bizarre. It's very, very modern. He said it's clean. Everyone is peaceful. They're very polite. And he told me, well, they were talking about geopolitics a bit. And he said, my friend is from France. I didn't vote for Macron. And the Chinese guy was saying, wow, you're allowed to do that? Not vote for the guy which is presented. And my friend told me, I didn't see a bird. And then it dawned to me that with 1.4 billion people, for them, EV is not because it's nice and, it's not the US with large country, not so much population per square meters. For them, it's like they have no choice. It was hugely polluted, and they are moving to EV not because, it sounds nice on politics. They don't care about politics. They have no election. They're doing it because they are very populated, and it used to be hugely pollution. They have gained 2-3 years in life expectancy in Beijing, not because it sells politically. They don't need to do that. It's just that people were dying because this is unbelievably crowded. So for them, the equation is different. So I think that you're going to see, they are 10 years ahead of their plan to get at 50% of EV. They're going to go more for only one reason, not because of the good of the planet, because if it's too polluted, the Communist Party will have trouble. And in India, I think they have the same. They'll have the same problem. For now, they don't care because they are at a low level of GDP per capita. But think with me: if you are in Australia, you have your car, which is fossil fuel. For you, pollution is what are you talking about? You say you'll go. This is crazy. It doesn't make no sense. Why are you going bothering us with ESG and all that crap? This is just crap. So, from one perspective, country which has space and it's not visible. Okay. For another one, they're doing it because they have no birds. And it's it used to be hugely polluted. So you know what I'm saying is that you got to put your shoes in both sides. I used to be the guy who say, why are they doing that? It's not economical. It's not about the economy. And that's why also they have accumulated a huge amount of debt in China that is related to scrubbing their factories and all of that. Again, not because it looks good, it's because otherwise they get kicked out. The Communist Party gets kicked out. That's as simple as that.
So it sounds like what you're saying with regards to China, that actually, as they move to electrify everything, especially the vehicles, with the amount of people and the amount of vehicles they have, and that they don't have a choice, that sounds inflationary for the metals, the underlying metals.
It's nice for copper.
Yeah. Let me ask you this.
And for silver, because silver is at a ratio that is too wide because of Bitcoin.
But so I was just gonna ask you about silver. So let's go there. Silver's priced at 50% off its nominal high and substantially below the inflation-adjusted high. It's used in more applications today: solar, military, electrification, and so much more. Like you were just talking about, the gold to silver ratio, the mean is about 50 over the last 50 years. And today it's around 90. The majority of mined silver comes as a byproduct of mining other metals. And last year, the silver mining supply was actually down. So what do you see for silver over the next coming years?
I love silver for those very reasons. And this huge ratio started with Bitcoin. Now, I don't know if you have Bitcoin investors. What I'm trying to tell them, it fails under the normal monetary demand. So there is a demand for currency hedges that has gone to Bitcoin, and it will come back to silver. And that's the reason why I see since 2019, when Bitcoin started to rise, you start to see this 90 times ratio to gold. Okay, you have three valid source of value for means of circulation. Demand, in-kind demand. Gold never started as money; it started as ornament, and it's very clear in the classics from Tooke, from Senior, from William Jacobs, Delmar. They all have written about the history of precious metal. They started precious first because it's lavish, it's beautiful. You want to put your sarcophagus of the pharaoh and everything is like wow. And 4,000 years after, everyone is like, this is the beauty is absolutely fundamental for people, for humanity. So people say, oh, the luxury demand is not real. They completely lose the point. They have no idea. They put that in tombs in what is Bulgaria 5,000 years ago. The Incas as well. They've never used gold as money. They just use for ornaments. It has value because it's beautiful. Now, people have thought that Bitcoin is a currency hedge. It's not. It's like a Japanification bond. And that actually, it started to plunge a lot in 2002 when the long bond rate started to move up. Right? It has no value in kind. It cannot be incorporated like, value in kind is basically food, you eat it. Silver, you do lots of things with it, jewelry, all those applications. Gold, you make jewelry, you make chips. And I have actually people asking me, what's the value of gold? Say, you're sending me a message from a device that has a chip which contains gold. And you're actually asking me this question? Well, that makes no sense. And you actually can use gold to produce bitcoins. Can you produce gold with a bitcoin? You can't. It's not usable in anything, so it has no value in kind. So when people speculated in 2011 and the price of gold and silver went too much up, then it went down, but it had a floor because it's used in value in kind, like food. Food, you use it to eat. The value in kind was your floor. You have no floor with Bitcoin of that nature. Now you have the circulation, demand, circulation money is how much is it used in goods and services. Okay? Goods and services is the way fiat acquires value. A pure scriptural monetary abstraction, a false currency that has no value in kind. So fiat acquires this value in circulation. What does that mean? Between 1866 and 1879, the US was on fiat. Between 1861, but between 1866 and 1869, McCulloch did a contraction. He reduced the amount of greenbacks. So basically, the greenback US dollar was going up against the European currency pegged to gold. So it was going higher than gold. It was not only fixed, because today people say, oh, Bitcoin is fixed. It was reduced, so it went up. But then they demonetized. It went to zero. Value of paper you burn. So it's not the scarcity, because the scarcity was even better than Bitcoin. It's first the monetization, then the scarcity. Because if you're not monetized, it's scarce. You forgot to convert your greenbacks after 1879. Oh, it's scarce. It's not monetized. And the only value it has in kind is to burn it. It's not much valuable. So this question of scarcity is wrong when you are a pure means of circulation that has no value in kind, not usable for other things. That's the problem of Bitcoin right now. Okay? And people say, well, but what gives gold value is because it's scarce. Wrong again. Tellurium is a metal that has very little uses, maybe a bit of solar panel, and it smells a bit like garlic. People which are poisoned with tellurium have this smell in their breath. It's 5 times scarcer than gold. Its price is basically $56 per kilo or per kilogram. It's the demand. So scarcity without demand. Now,
so do you see demand for
silver should benefit from that.
So that's exactly my question. So you see demand for silver increasing?
Yeah, both from the industrial, because China, then India, they're going to get to a point say, you know what, we are out of absolute poverty. Now let's make sure that we don't die in 20 or 30 years because we are so much intoxicated. So it's, again, if you live in Australia, that sounds foreign to you, so you're crazy. It doesn't make a difference. If you are in very populated places, even, okay. So they have to do it, even if it's non-economical. That's the thing. Is that even if it's like too expensive, they're gonna have to do it even then. So now, if you live, and then there is this issue of Bitcoin, which is not a monetary hedge because it has very little demand for circulation. There's only 70 billion to 120 billion that are transacted in Bitcoin. That's the fiat acquired money because it was used for transacting goods and services, as I explained in the 19th century. the greenbacks were dealing that. This demand for circulation for Bitcoin, even including crime, which is 50 to 100 billion, you add the legal one, it's only 12% of people in Salvador use that Bitcoin last year, so it's very small. The amount of use for that is very small. Now, the real money demand for transaction is very small. The demand for central bank money demand, so you have circulation money, you have value in kind, precious metal, rich and beautiful or other thing. You have circulation money demand very small for Bitcoin, and bank money, settlement money, or central bank money like gold as a reserve and to trade settle, they have no demand for that. The real demand you have is spec demand. That I explained in 2011, gold and silver went up too much. That's the only, you have this demand, but this is not money demand. You know what I'm saying? It's that's the problem with Bitcoin.
So, okay, so a final question on gold. Ray Dalio was asked in a 2023 interview on CNBC about how much a fund or an individual generalist investor should have in their portfolio. And his answer was a 10 to 15% overlay on the portfolio. Do you agree with Ray?
Totally. And I would go, I would say, you know, you could save some of your, you can have a bigger boost by putting 10%, 5% silver.
10% gold, 5% silver?
Yeah, because with the problem that Bitcoin has, the currency hedge is false. And if the demand for currency hedge doesn't change so much, the supply with a problem on crypto will go away. And as a result, you have a shift back to the traditional currency hedges.
So with you see silver, that?
Yeah.
Yeah, you see that coming here over the next couple of years?
Yes, for one particular reason, is that Bitcoin has a duration problem. What is this? Bitcoin behaves best when you are in Japanification. And I'm going to explain that in 2 minutes. When you have lots of bonds that pay nothing, and one of them pays nothing, but the supply is restricted, what happens? People go to the Bitcoin. So you can see that it's actually when the rates went to zero, the Bitcoin was going like to the moon. And you go, I'm going to send you some charts. You're going to see that as rates went down, went up in 2002, Bitcoin was doing nothing and actually plunged. And then we had the dead cat bounce on the bonds, and they went from 5% on 10 years to 4%. That's exactly when Bitcoin went up again. Okay? Now, why duration? You have a cost of opportunity in Bitcoin in the terms of interest rates. They don't pay interest rates, right? You might say, well, if I invest in an index of soft commodity, they don't pay interest either, right? So it's the same. No, because if you have higher nominal interest rates but higher costs, like 70s style, if you don't pay up to cover the cost for the in-kind consumption of food, you don't eat. So the floor, in-kind floor of soft commodities rises. So yes, you don't have interest, but if you want the food, you have to have, basically you invest in cost for consumption. And actually, soft commodities perform better in the Napoleonic Wars in the UK, also perform better in the Civil War in the US, and also perform better in the World War I than gold that was floating. Because the demand is inelastic, and if the currency plunges, the utility of food doesn't move. So it's basically people think food is moving up. No, it's a currency going down. And it's so critical that currency can keep going down, utility doesn't move, and if you divide something that is the same by a smaller and smaller currency, then the price is higher and higher and higher. There is no in-kind demand for Bitcoin. You can't eat it. You can't make jewelry. You can't make stuff with it. Nothing.
So I heard throughout our conversation a theme or a common thread of inflation. And so it seems to me that that's where you feel we're going to be living for quite a while, is in an inflationary time frame. So before we wrap up here, and I ask Geoffrey the final question, I want to remind everyone, if you're a premium subscriber to our Substack, which is metalsandminers.substack.com, not only do you get a bunch of free content throughout the week, but you also get the nugget notes from each interview, which is our downloadable recap summary of this discussion with Geoffrey. You get some premium interview content with Geoffrey that's not on this video here, and access to Metals and Miners Critical Report Library, among other benefits. So if you've enjoyed this conversation with Geoffrey, even half as much as I have, and you'd like Geoffrey to come back on in the future, please let him know by hitting the like button, clicking on the red subscribe button, and also hitting the little bell icon. Geoffrey, this has been a really interesting hour conversation. I really enjoyed it. Thank you for being so generous with your time, your analysis, and your ideas, and for coming on to the Metals and Miners podcast. It's really been so good to spend this time with you. You're absolutely welcome back anytime that you want to share updates with us, what's going on in the economy, markets, et cetera. Would you tell the viewers where they could learn more about your work, how they could connect with you, and where you could be found on social media?
All right, so you can check Graph Financials. Graph Financials, because we have created a new technology that is mixing graph database, augmented web, and so it's a new media. I have another company which is called DocuTalk.io that is providing a system that has been got an award for IR Magazine New York for the 30 years tech column. It's something that you can't tell if it's a video or document. It solves a lot of problems when you need to explain documents, converse on documents without web conferences. That's what we do. So for the technologies, DocuTalk.io, and we use this technology to teach or show the greatness of classical economics in graphfinancials.com. So all those things that were forgotten on miners, on margin on miners, there's Fullerton. We discussed that. We discussed the manipulation that happened in the French Revolution on silver. So people say there's no manipulation. There were historical. We have plenty of examples. Lots of historical. Our focus is historical, classical, with this new technology. That's where you can find us. Graph Financials on Twitter, graphfinancials.com, on the tech, DocuTalk.io. And thank you very much, Gary, for inviting me.
Yeah, thank you again, and I look forward to speaking with you again soon. Okay,
Perfect. Bye now.